This is the hedge. No, actually, this is the story of how Metal Gesellschaft Refining and Marketing, also known as MGRM, cost its parent company, Metal Gesellschaft, also known as MG, over $1 billion in margin calls due to a hedging strategy. In 1992, MGRM implemented a new marketing strategy. They took a short position in over 100 fixed-price forward contracts with maturity up to 10 years. In order to offset this short position and the exposure to the purchase of barrels of oil, MGRM hedged by taking a long position in short-term NYMEX WTI oil futures. This was known as stack and roll hedging. If oil prices dropped, MGRM would lose money on the long position while the fixed-rate short position increased in value. However, a problem with this strategy is that when oil prices drop, the gains from the sale of the oil are realized over the long term, but the losses on the hedge will be realized immediately, resulting in margin calls. This took place in 1993. The losses on the hedge in the short term resulted in margin calls. The cost of rolling over the futures was $88 million in October and November. In order to cover these costs, MGRM had to obtain funding from its parent organization, MG. Due to a lack of understanding of the communication between MGRM and the parent, MG closed the positions in an attempt to diminish further losses. In December 1993, the company cashed in its position at a loss of over $1 billion. This was considered another derivatives-related disaster, but on further investigation, it emerged that these losses were an exception to the rule, occurring while hedging, not speculating. Two very different views on the effectiveness of this hedging strategy exist. Culp and Miller argued that the strategy of MGRM effectively reduced their oil price. Others, like Mello and Parsons, argued that MGRM actually increased this by using a grossly oversized position. This graph shows us the crude oil prices between the years 1985 and 1995. As you can see, the oil prices decreased in the year 1993. Futures prices converged to the expected market spot price of the underlying asset over time, due to the emergence of new information. In normal backwardation, the futures price is less than the expected spot price, and so this is expected to increase. This is desirable for investors who net long. In contango, the futures price is greater than the expected spot price, and so it is expected to decrease. This is desirable for investors who net short. Contango can be attractive for traders who are buying underlying assets at a cheaper rate, where they can store it to be sold at a later date for a higher price. This idea locks in profits through buying the underlying asset, in this case oil, and selling forward contracts for this asset on the futures market. Due to the hedging strategy and futures contracts chosen by the MGRM, a basis risk existed, and a perfect hedge was carried out. MGRM chose to hedge the long-term short position with futures contracts of short-term maturities. It has been noted that MGRM influenced the market dynamics due to the size of the hedge undertaken. The dynamics of the market changed in September 1993 when the market became dysfunctional. This occurred as MGRM was squeezed by other market participants. They developed a herd-like behavior, anticipating MGRM's role over hedge and essentially betting against them. The squeeze on MGRM steered the market into contango, which changed how the hedging strategy worked, performed, and was viewed by management. A source of trading profits became a source of trading losses. In an otherwise economically efficient hedging strategy, the immediate trading losses from the hedge position led to a liquidity prize. Margin calls came in for the futures contracts, but the profits from the short positions in long-term contracts had not yet been realized. The issue of liquidity risk came into effect when the oil futures market slipped into contango in late 1993. By December 1993, the parent company MG deemed there were insufficient funds available to keep the project afloat. They decided that MGRM had insufficient funds to cover the margin calls for futures contracts entered. Therefore, it is apparent that the issue of liquidity risk stemmed from the issue known as basis risk. As the prices in the energy industry began to stumble and decline, MGRM was forced to commit further funds to their long position on the futures contracts. Due to their large position on the futures contracts, a vast amount of funds was being used to cover the margin calls, while simultaneously the profits from the customer contracts was not enough to offset the huge margin calls in the short term. Further compounding the issue of liquidity was the issue on how the losses incurred were tabulated, due to differing standards and accounting practices in Germany and the US. From a German perspective, unrealized profits that the forward contracts would have brought in the future are not accounted for. However, in the US, such unrealized profits are accounted for. This difference in accounting practice led to great confusion between MGRM and the parent company. In the long run, this basis risk would have evaporated if contango had continued, and liquidity risk would have continued. However, eventually in the long run, the gains of the customer contracts would have cancelled the huge cash outflow they experienced at the beginning of the strategy. Alternatively, if the market had returned to backwardation, the issue of liquidity risk would have disappeared, because MGRM would have made gains on their futures position.
When new management took over MGRM in December 1993, there were several issues caused. There was a lack of communication of the accounting principles used, as mentioned previously. There was also a clear lack of understanding of the derivatives market by new management who made rash and uncalculated decisions. It is possible that they may have had ulterior motive for liquidating, as new management wanted to absolve themselves of any blame and attached all the blame to the previous management. New management could have stopped the hemorrhaging of cash outflows on the short-term futures contracts. This could have been done by purchasing put options that would have matched the outflows or at least limited them. Culp stated that this strategy would have minimized losses to an estimated $125 million, much less than MGRM actually lost in the end. Even without choosing to purchase the put options to limit the downside risk, MG was part-owned by some of Germany's largest financial institutions, such as Deutsche Bank and Dresdner Bank. As such, they should have been easily able to source funding required to meet the cash outflows of the margin calls, at least until the oil market returned to normal backwardation. Alternatively, if the hedge was valued under US accounting rules, it would still have had a net present value that was positive, and the forwards contracts would have perceivably been attractive to investors. Culp estimated their value at $800 million. The contracts could have been used as collateral with which to obtain the funding required to meet the margin calls. JP Morgan proposed such an offer but were snubbed by MGRM's management.
The forward contracts could have been bought back from gasoline retailers. However, this would probably have yielded a low return, and selling them would have demanded a heavy discount before parting the contract. In conclusion, it is believed that the stack and roll strategy taken on by MGRM was in fact economically efficient. A massive loss accrued was not down to the strategy, but actually down to other factors, such as a lack of communication between MGRM and the parent company MG, and differing accounting practices in Germany and the US. This caused the hedge to be closed far too soon and at an unnecessary cost.